A decade ago, Kenya's capital markets regulator, the CMA, laid out a plan to have at least $50 billion worth of derivative products trading in East Africa's biggest securities market. That goal, however, is yet to be realized. After a 6-month pilot in 2018, regulatory approval was finally granted to start trading in equity derivatives in May 2019, with investors getting access to single stock and equity index futures. However, plans to introduce financial derivatives, which would essentially allow investors to lock in future prices for currencies, did not take off. Given the near 30% fall in the Kenyan currency in 2023 and dollar access problems the year before, I asked the outgoing CEO of the Nairobi Securities Exchange, Geoffrey Odundo, if that crisis represented a massive missed opportunity. I know the last time you were in studio, when we had this conversation, I was giving you a bit of a hard time about the introduction of FX derivatives, which was a little early back then. It was still in the pipeline, still in conversation, and then my question was, okay, when? When are these coming to market? Looking back though, what were the hurdles in getting that product to market? Was there demand for FX derivatives in this country? Because coming back off the back of this currency crisis that we've had, Kenya shilling moved around 30% last year. And at the time, I remember talking to some market players, and especially on the banking side, and there's some individuals who are asking, if we had an opportunity to essentially, lock in some exposure to the currency at X, through forward contracts, we'd have taken it then. But the product didn't exist. That seemed like, to put it a bit crudely, but that seems like a crisis that we missed out on.
Yeah, Rama, you're quite right. The whole essence of, or the whole purpose of setting up the derivatives market was to provide a transparent platform for trading of FX contracts. We already as a country, we are very active in that space. The banks are doing a lot of trading on forwards, swaps, and all these opportunities. But they don't have a centralized platform for doing that. It's all separate. It's all OTC. So we were trying to give an opportunity for them to converge and get better levels of price discovery. Unfortunately, there was a bit of concern from the central bank that they needed to understand the product. They were concerned about the timing. At that time, FX, the foreign exchange rate, was sort of a bit of a concern in that they were very concerned about how it behaves. So we didn't get that desired support at that time. So we said, let's set off with our equity contracts first. Let's see how this play out. Let's build the market and understanding, and then we'll bring the others later. But the plan was to roll out that. Now look at it to the hindsight and see how the currency has behaved. We have had opportunity, Investors had great opportunity to hedge positions, both upwards and downwards. But now we didn't, that for the lack of that market, we've now just let, as you said, the crisis has just gone to waste. So I think we are hopeful that the new regime would be very warm to this. We've had a first conversation with them. They're happy to hear more.
With the government side and CMA, or the central bank?
The central bank. So we hope that we've got a working committee with them to build understanding about how the impact will be and all this, and addressing all the risks. So the team that I leave behind, I'm sure, are going to be able to progress this matter.
Are there any timelines on that discussion, or is it still at sort of the exploratory stage at this point?
It's still exploratory. The good thing is that we have data to back up what has happened on the equity contracts. We can demonstrate how the whole framework has worked. We've never had to resort to any default waterfalls just to protect the market. Everything has been working extremely well. So we think that with that assurance, we could have good conversations with them.